Hey, I'm Eric Burkholder here with Jordan Bradford, a senior advisor at Burkholder Wealth Management, and this video is going to give you a market update for 2023.
Yeah.
So, uh, ended up being a really good year. I would say at the beginning of the year, that was certainly not what the vast majority of people were
No,
predicting.
not at
A lot
all.
of people guaranteed a recession,
Yeah.
um, and we'll get into the numbers, but this is just another good example of do not trust the talking heads on TV. So,
Yeah.
did we, Jordan, I'll ask you, did we enter a recession and was the market negative for 2023?
Well, the answer is no to both of
That's
those,
good.
which is
That's
great.
good.
It's always good to answer no to those two questions. In fact, as you mentioned, we did see at the beginning of 2023 almost every industry expert, market expert, if you will, right, predicted that we would hit a recession that may or may not lead to negative returns in the market. There was varying opinions on how bad a recession might be. There was doom and gloom to start 2023. And what's pretty impressive is that not only did we not hit a recession, but GDP numbers just basically kind of got better and better all year long. And we finished the year, with GDP growth of 3.1%. And I think the average analyst estimate going into 2023 was about zero point 0.1 to zero point 0.2 growth. So, there was a lot of negative opinions that lead to an average of about 0.1, 0.2. So even the best case scenario for a lot of people was it's going to be a flat year on the economy, and let's hope we get through this high inflationary period unscathed. And I think that 2023, from a market perspective, went about as good as you could possibly hope for.
Yeah. So, and you mentioned obviously GDP ended up being much better than anticipated. Inflation moderated substantially. And then we also had the Fed saying that basically we think we're done raising rates.
Yeah.
Market clearly believed them. And we had an extremely good fourth quarter.
Oh, yeah.
And again, a lot of the returns came in that fourth quarter. So if you were waiting to get in, you may have missed it because basically it was trudged along and we're negative at some point during the year, and then we ended up having an extremely good finish to the year.
Yeah, and even in, I'll say a normal year, right? There is no normal year. That's the disclaimer. Every year has got something going on, some news headline, something that's going to lead someone to believe that this is the year the recession hits. This is the year where the market just really tanks, right? So there are no really normal years. But if you look back, annually, typically, your best returns in the market kind of come in a pretty short period of time. And we had a really good market across the board in 2023, and a lot of that came in the fourth quarter. And that's where we talk about, staying invested. The reason we want you to stay invested is because I can't predict which quarter is going to be the best quarter, which month is going to be the best month.
Right.
I know that eventually we're going to get good returns, and it's going to happen over a long period of time. But if you sit on the sidelines, the chances of you missing those really good returns are very high, because oftentimes they happen, in a blink of an eye. They just kind of go in and out, and you all of a sudden you look back and you're like, I just missed an 11% month, and how did I do that?
Right.
And then you're back to square one of, you think the market's too high, right?
Yeah.
So it's very dangerous to be trying to jump in and out. And I think 2023 was one of the better examples of that. In our recent 10-year history of the U.S. markets.
Yeah. So maybe give us some of those numbers. How do we end up?
Yeah. So the Dow Jones was up about 16%, 16.2% for 2023. S&P 500 had a great year, up 26.3%, and the Nasdaq had a whopping 44.6% return.
Wow.
Which, if we had numbers on a screen here, we'd put a little asterisk next to that 44.6 though, because while you got that return if you were invested in the Nasdaq for 2023, you're still a little bit down if you were also invested in that for the entirety of 2022. Which some people might be saying, how's that possible?
Yeah.
Because in 2022, the NASDAQ was down about 32.5%. And if it's up 44.6% the following year, simple math would say that's a 12% return. I should be up 12%.
Right.
Unfortunately, that would be the case if you got the 44% first, but you didn't. You got the 32% down first. So you had to actually earn about 50% to get back to even. So while a NASDAQ investor had a very good 2023, they're still down a little bit if they were also invested in that in all of 2022. And that goes to show you just kind of how important it is to be diversified, so that you don't end up with, riding that roller coaster of a wave. Because I know as a value investor, I look at something that's done 44% in the most recent year, and that probably makes me balk a little bit about buying more of that, right? I think that's how most investors would be. You shared with them any individual stock, any individual security of any sort, and said it was just up 44%. Do you want to buy it now? Most people would say, I'd rather have bought it a year ago, right?
Yeah.
And that's kind of where you're at with the NASDAQ now, is if you've been riding this wave, you just had one of the better years for the NASDAQ in recent memory, and yet you still are not at your high point.
Right.
So, being diversified can be very, very helpful, because the NASDAQ's positive now. The Dow's hit back above its all-time high, or hit its all-time high. And so, you get a lot more relief if you invest a little bit more diversified.
Right. Yeah. And part of what we also talk about is the best investment strategy for people, or is the one they can stick with.
Yeah.
And so, and we actually have seen this, like not a lot of people have stuck with a 100% growth strategy the last couple of years. And you can imagine, being down in the 30, what did we say, 32% in 2022, having to stick through that to get the full return this year. And that big swings up and down, even if you ended up on a 2-year time frame with the same return, I would be shocked if that was a good experience.
Right.
And so we're always trying to get the highest rate of return we can with an investment experience people can stick with.
Yeah.
And the NASDAQ, again, is at, from a valuation perspective, is at multi-year highs. And so to your point, is like, do you want to get back in after it's gone up 44%?
Right.
And you may, if you did stick through it and you just broke even, you probably feel like, oh, I want to stay in now because I just went through all that. So that's that emotional roller coaster of of that type of investment experience, which is very difficult for people to stick with.
Right.
Speaking of markets, while bonds typically are not the most exciting part, we've had an exciting couple of years in the bond markets.
Yeah, absolutely.
So maybe tell us also about where we're at with fixed income.
Yeah, so any bond investors out there, I'm sure you distinctly remember how 2022 went. One of the worst years on record for bonds in the United States, and really internationally too. It was a really bad year for bonds. And a traditional 60-40 equity fixed portfolio, which is, for a long time, that's been kind of like, you could kind of call that like a retiree style portfolio, right? That 60-40 type portfolio had about the worst year it could have in 2022, because you have 40% of your allocation assigned to something that you are expecting is going to prevent you from seeing, significant decreases in a down market. Well, the S&P 500 was down over 20%, and your bonds were down 10, 11, 12%, sometimes worse, depending on where they were located, the credit quality. A good average was about 11% that the bonds were down in 2022. In 2023, we have seen bonds have definitely recovered quite a bit, and we're seeing a lot better performance there. But I think really what's interesting is you look at like the 10-year Treasury, which started 2023 about 3.8%, roughly 3.9, and it ended the year at 3.88. So it was almost flat for the year, but it wasn't a flat ride in 2023 for the 10-year Treasury. It peaked about 5%, and its low was about 3.25. And so if you were trying to time even the Treasury market, that's a pretty substantial difference, in a single year for a Treasury. Right. For a stock, that would be nothing. A difference between 2% nearly over the course of a year, that would be no fluctuation almost. In a 10-year Treasury, though, that's a lot. And the 2-year Treasury is sitting at about 4.25 almost. almost at the end of the year. So, I think what that's telling us is that the markets are pricing in essentially that we're going to see some rate decreases at some point here. And so you're actually getting paid more to shorten the duration on your treasuries, because their expectation is that you're probably not going to get 4.25% on a 2-year, 3 years from now or 4 years from now.
Right. But interest rates, I mean, in bonds, really the market overall, in our opinion, is much healthier, right?
Yeah.
I mean, where we went over a decade of getting virtually nothing for owning bonds, now we're very much within a range that's historically normal.
Yeah.
Not only does it make it easier for bonds to recover if we were to have a rate increase or something, because when you're earning 4%, you can recover a loss much quicker than when you're earning 1%. It's just basic math there, but it is a very beneficial to clients that are retired that are owning bonds. It's going to make their return a little bit more consistent going forward. I think for a lot of reasons, for investment opportunities, discouraging bad investment. I mean, rates are in a good spot, and I think that's why the Fed is signaling they may be done raising, maybe even cut. But I think, where we're at now is not a bad place to be. In the grand scheme of things.
Yeah, it certainly is vastly different from the 0% interest rate environment we were in on savings here, not long ago. So, finding that healthy, center point is very difficult, which is a big reason why many people were making predictions about how bad the markets were going to be and how bad a recession was going to be in 2023, because we all pretty much know it's difficult for the Fed to thread that needle of let's combat high inflation, but let's try not to send us into a recession. Meanwhile, they were saying they were willing to send us into a recession. So, I obviously, I know that there's plenty of factors going into the markets, but I think the Fed did a pretty good job, all things considered, of not overreacting to the point where it pushed us into a recession. But also, it seems like the interest rate increases have also done a good number on inflation, because we're seeing now through the end of the year inflation at 2.9%, which is really, really close to the Fed's long-term target.
Yeah. So those numbers just came out this morning, and again below expectations, and we've dropped below the 3% rate. So, those are all positive signs, and although the Fed, I'm sure, wants to take full credit for it. Obviously, we went through a pandemic, we're recovering. There's a lot of other things going on, but I think this is almost, I don't think anybody could wish it to be much better, right? Obviously, ideally, we'd have no inflation, but given what we've been through, we're in a pretty good spot. And that bodes well for a good economy going forward. We don't know, right? And we don't invest based on trying to predict what the economy is going to do, but I think it's important to, take the good information while we can get it. And I think a good follow-up to that going into this year, and we have another video out there on the election, so we encourage everyone to watch it. But who's in office and the economy are not the same. There's actually very little correlation. Although when you do studies, the vast majority or not a majority, but more Democrats think we're in a bad economy when they're in control of office, and when Republicans are in control. Sorry, let me start over. Democrats think we are in a bad economy when Republicans are in control. Republicans think we're in a bad economy when Democrats are in control. Regardless of the actual economy, and that's both sides. They're equal offenders on that case. So, try to look at it as objectively as possible. If you tend to lean on one side of the aisle and your party's in control, maybe you're looking at it too optimistically, and then if the other party is in control, maybe you're looking at it too pessimistically. It's probably the truth is somewhere in the middle. I think that's kind of where we are. The economy is kind of somewhere in the middle. It's doing okay, and that's a good thing based on where we were at a year ago. So. Oh yeah,
I think if you could have asked for your ideal situation, a year later at the beginning of 2023, I think the numbers in the market would be probably higher than what you would have asked for. Inflation would be back down to a number that you probably wouldn't have asked for either, because you would have thought that might be too unrealistic. Even GDP, I think when you look at everything in the economy and the markets for 2023, I think we got about best case scenario in most areas.
Yep.
Which you have to take that when those years are good, because there's no economic situation where every single piece of the economy is going to be humming along at perfection.
Right.
But the market returns and GDP and inflation, it all tells a story of how the economy is moving, as a big unit. Thinking of a massive cruise ship just moving through the ocean. It's moving slowly, but it's moving a lot.
Yeah.
And that's kind of like what the market is it's moving, and we're getting a lot of good data. And I think we've got some, reasons to be optimistic this year. But that being said, we're not going to try to time the market, and we wouldn't encourage you to do either. We want you to stay diversified and invested. And as Eric has said, sticking with the portfolio or investing in the portfolio that you can stick with, right, whether the party that you think is best for the economy wins or loses. I think that is going to give you the best investor return. Yep. Is finding a portfolio that you can stick with.
Yeah, exactly. And so, 2023 in summary, really good year for the market. Yeah. We're not going to complain about it, and who knows what will happen this year, but we know that if you're invested appropriately, as you just said, you're going to be okay. So I think that's all we have for now. We'll see you on the next video.
Thank you.